This is a presentation on Silicon Valley real estate market geographically, single-family homes. This is the introduction that will be at the end out of courtesy people that are repeat visitors. I'm Richard Calhoun with Creekside Realty, working with buyers and sellers here in Silicon Valley. We are week number 14, April 6th. These URLs are key if you want to come back and look at archives, and that's also discussed on the how to participate at the end. Here's the first data slide. This data is accurate as of the morning of April the 5th. We start off and we look at the active inventory compared to the 10-year median for the same week. You can see the red color means for those areas there's a shortage of inventory. Moving on and looking at the buyer's offers accepted in the past 5 weeks compared to their 10-year median for the same week, you can see that there's also a shortage of offers, which is why it's blue in color favoring the buyer. Now we flip over and we look at the supply-demand ratio. Here you have some balance, you have some blue, and you have some red. So red favors the sellers, blue favors the buyers, neutral is roughly balanced. And again, this is comparing to the 10-year median. So it tells you whether you're slower than faster than the typical marketplace is for the same time of the year. The next columns up here are yellow because these are current market indicators. The red here, the pink, tends to indicate that that's faster than normal, so it's going to be a hotter marketplace. The blue indicates that it's slower than normal and therefore a cooler marketplace. Many of the micro market areas are roughly in balance, which is basically from 88.5% up to about 112%. Then we move on and we ignore the 10-year comparison. We just look at days on sold inventory now. What is the inventory demand ratio, the supply demand ratio in each one of the different 20 micro market areas in Silicon Valley? You can see that we have a short time frame here of only 10.7 days in Central San Jose, in Sunnyvale and Cupertino. We also have 9.7 days down here in Foster City, Redwood Shores. Theoretically, what that means is in that time frame, everything would sell if the rate of sale stayed the same and there was no new listings. But that's pretty theoretical, but it's an instantaneous benchmark of what the market is. Very closely related is the days on marketplace. But instead of looking at the median and average, both of which have significant negatives, I look on the 75th percentile to get rid of those negatives. What is the time that it takes for 3/4 of all the successful sellers to sell their property? And you can see it's basically just under 2 weeks for most of the areas in Silicon Valley. There's a few like right here, San Mateo County coast is at 7 weeks. That's dramatically different than coming into Saratoga, Los Gatos, where it's only 9 days, which is just over 1 week. Then we move over and we look at sellers' expectations compared to the marketplace. What are they doing to get the offers? Are they raising their price? Or are they lowering the price? As it turns out, red is raising the prices. That clearly favors the seller. Blue is significant price reductions, and light shades of either or no color at all is sort of a balanced marketplace. And you can see this is a very, what I call a tight metric, that it's pretty insensitive. There's not much fluctuation, and that's because the vast majority of the sellers do their homework before they put their house on the marketplace and price it correctly to sell right away, and they don't have time to sell. Then you have their ask price adjustments, the frequency. So you can see that in a lot of Santa Clara County, you have less than 5% of the sellers adjusting their price. In San Mateo County, it's probably a little bit over 5%. And then you go down in Alameda County, and it varies dramatically from less than 2% up to 18%, depending on what area you're looking on. Then the next two columns are overbidding. This is what the buyers do. But because we want to get the bidding, the overbidding, you have to wait for escrows to close. There are orange highlights at the top because there's a 4, 5, 6 week delay in getting most of that information. And so this is a lagging indicator of where the market was. But again, you can see that in Santa Clara County, a lot of the areas are getting 12% or so overbids. In San Mateo County, the number looks like a little bit lower, maybe around 7, 8%. In Alameda County, it's around 10%, 12% potentially. And then you look at the frequency, how common. Santa Clara County, around 85%, around 2/3 in San Mateo County, and back up to about 85% in Alameda County. And then we look at the long-term appreciation. Now, the last two columns, we're getting away from favoring the buyer, favoring the seller, because appreciation doesn't favor either one. Appreciation's how you've done on your investment. A blue color is sort of a lower than performing area. The red are better performing areas, and the white are basically what the average appreciation's been, or the median appreciation. And you can see right here, the median appreciation is right around 85%. Some of the better areas are a little bit over 100% appreciation. I think the high one is down here right now in Newark and Union City at 110% appreciation. And this is appreciation since the last 9 months of 2015. Moving on, instead of just following the median sold price, which is the middle number, I sandwich it with the cheapest 10 percentile and the most expensive 90 percentile, and the median is obviously the 50 percentile. So you have a range. You can figure out, meet with a lender, figure out what your price range is, and then figure out what micro market areas you have a chance on making those payments. And again, colors, basically the red is the more expensive areas, the blue are the more affordable areas. And then the last column is the PITI, assuming an 80% loan, 30-year fixed mortgage, and it's assuming the same 10 percentile median percent and 90 percentile pricing. So the color code would be the same as the price, and that's why it's not listed. Now we're looking at each individual metric, and we're looking at active inventory compared to the 10-year median. Red is basically, as I said, favoring the sellers because you have less than the normal amount of market. In Alameda County, I just have countywide data, but I'm mapping it out so it's the same number for each of the 7 micro market areas in Alameda County. The other 2 counties are individual and accurate for each micro market. Moving over and looking at offers, so you can, like the inventory, there's generally a shortage of number of offers. So we're selling less transactions, less properties than we typically do for the time of the year. And then the days of unsold inventory, this is the speed of the market compared to the typical market for based on the 10 years. You can see the San Mateo County coast is the real slow area at 161%. So it's 61% slower than it typically is. And then Redwood City and Foster City are basically tied, and they're right around 57%. So they're quite a bit faster than they typically are. Now you're looking at just the days of unsold inventory today. And this is simply a theoretical number. It shows you the slow areas being the expensive areas, and you can see a little bit of difference that, San Mateo County coast is no longer the slowest. If you move back here to days on inventory compared to the 10-year median, it's the slowest relative to where it typically is. But in terms of absolute speed, the expensive areas in San Mateo County are a little bit slower, and that's why there's a little bit of a pale blue here. The lower the number, the faster the market is, the more competitive the market is for a buyer. Now we're getting rid of theoretical and comparison numbers for someone that wants just a simple metric. What's the market doing? How long does it take a seller to sell? This is the time it's going to take the long, typical successful seller to sell. Basically right around 10 days for most of Santa Clara County, probably right around 2 weeks for most of San Mateo County. And again, Alameda County is sort of split with a lot of areas, or 2 areas below 9 days, 8 and 9 days, but then you have 14, 13, 16, 28, 17. You have some slower pockets of areas, and you can see that in the color code. You can see some white up here, which is the Oakland area at 28 days, but right next door is Alameda, and then not shown on the map is Berkeley, is down there at 17 days. So 2 areas that are next to each other geographically, significantly different. You're sort of seeing that the whole market, though, is selling pretty quickly. You go anywhere else in the country and you say you're selling most of your homes out in 2 weeks, they go, wow, that's a fast marketplace. Here's the seller's ask price adjustment. So this is what the seller is doing with their own ask price in order to get the offer in the door. You can see the San Mateo County coast is taking almost a 4% price reductions, which basically equates to the seller's expectations were higher than the market, which is the buyers, were setting the price at. It's also noteworthy, some of the ones right up top where my cursor is, right up top where my cursor is, are positive numbers. So that means the sellers actually raised up their price. Now that could be a seller raising their price because they were getting flooded with buyers and they thought maybe they priced their home too low. It could also be after offers came in, wanting to more accurately reflect the sale price. So you can see there's 4 areas that are raising their price: East San Jose, Central San Jose, and South San Jose, Milpitas, North Valley, Berryessa, and Santa Teresa. So 2 areas that are basically the affordable areas along the eastern foothills of Santa Clara County. And then in Alameda County, you have 2 areas, Fremont and Union City and Newark. So you have this strip of land up along the east side of Silicon Valley where price adjustments are in the positive direction. So sellers are actually raising their price. Here's the frequency of price reductions. You can see these numbers are very low. The highest areas with only 22%, one of 5 sellers are reducing their price at all, and they're concentrated over there in the San Mateo County coast. You can see a lot of the areas are around 2-3%, and then a group around 6. But basically, the vast majority of Silicon Valley is less than 1 in 10 sellers are adjusting their price. Now we're flipping over and looking at the magnitude of overbidding. So this is a lagging indicator because you have to wait for escrows to close, 4 to 6 week time frame. You can see Atherton is 1% overbid, so they're getting 101% of their asking price. You go into Milpitas and it's 11.8%, so 111.8% of the asking price, almost 13% up in Campbell area. Come down to Alameda County, Fremont is at 12%, Berkeley's at 14.5%. So you can see the different areas of where the overbidding is. And basically the entire valley, Silicon Valley, the 3-county area, is in an overbid situation. Now here's the frequency of overbidding. How common is overbidding? On the coast, it's less than 1 in 4. It's getting close to 1 in 5 sellers are getting more than their asking price. The next lowest that I'm seeing right off the bat is Atherton, the expensive areas in San Mateo County, where exactly every other seller is getting more than their asking price. You come into Santa Clara County and it's right around 85%. Yes, there's some areas like Saratoga, Los Altos, Palo Alto, it's 75% plus or minus. And then you come down into Redwood City and it's, 70%, 2/3. So clearly a little bit less common overbidding, but still very acceptable levels of overbidding. And then you go into Alameda County and it's a lot more like Santa Clara County. Here's the appreciation. Here, color has nothing to do with favoring buyers or sellers. It's simply the hot areas had the most appreciation since the last 9 months of 2015. The blue areas have the least amount of appreciation. And you have a divide where the areas on the west side here have had the least appreciation. And I believe that's directly related to COVID. The job centers tended to be up along the Mid-Peninsula area, and people didn't have to go into work as often or as rigidly as they did it before. And those areas lost their premium for being convenient. The outlying, more affordable areas are now getting a huge premium for their location, and therefore they have the most appreciation since 2015. And the reason that is the appreciation is typically the same amount, and whatever appreciation is the most recent because of compounding is usually the one that has the most overall appreciation rate. Now, instead of just following the median price, which is the middle number, I follow the 10 percentile and the 90 percentile. So you get a sandwich. You know what the typical property is, but you also know what the outliers are. So you can pick what geographical areas you want to focus on based on what you can qualify for. Now we're moving on from micro markets and putting everything in a blender and just looking at what the overall market's doing. So you come down here and look at inventory. Inventory is down here right around 75% of where you'd expect it to be. Moving on to offers, the orange line is right around 80%. Because offers are a greater percentage than the active listings, that gives you a DUI below where you'd expect, and it's just about 88% of where you'd expect it to be, 12% faster than you'd expect. This table is here basically for the last line, and right now we're the second worst year. Now the worst year was, and by worst, the lowest number of transactions was back in 2020. But what happened in 2020? They announced the pandemic and we weren't able to show properties. So when you look at a 5-week moving period of time, by the beginning week of April, the pandemic was starting to impact your data. In fact, you can see it happened the week before where we were at 20. So now the last 2 weeks, the worst year was 2020, with 2024 only being the second worst. And you're seeing that over here by the 24 out of 25 years and 9 out of the last 10 years. Here's the estimated payments. The cheapest payment that a person buying a property in Silicon Valley would be about $7,000 a month. The typical would be up here at about $13,000, and the most expensive would be up here about $27,000 a month if they did an 80% loan. Here we're looking at the ask price reductions. This is a weekly distribution. The the green dash dotted line is where we are right now this week. The blue dash dotted line is where we were a year ago. So you can see the market is hotter than it was a year ago. So sellers are more realistic or underestimating the market more than they did last year. The worst year distribution we had was back here, which was basically the end of 2022, right after the market did their last correction. The best we had is way up here, which was right around Valentine's Day of 2022, right at the peak of the market. So we went from the best week we ever had to the worst week we ever had in a period of just 10 months. We'll call it 10 months because it was the end of December and the middle of February. So there's a month and a half there. But 10 months, we went from the best week we ever had on sale price reductions to the worst. And what we're going to do now is we're going through this distribution for each week. The dotted lines are the oldest, the dashed lines are the next oldest, and the solid lines are the most recent. So we start off a year ago and we move a month at a time. Once we get down to 3 months, we ship right there, we ship the weekly data. So there you can see we started going up. And the purple, which is coming up right there, that's the peak. So that's actually saying on current, we've now gone down 1 week. 1 week does not send a trend. And that's one of the reasons I do this weekly is I believe you need 3 data points, but at least it's giving you the indication that the market is no longer accelerating. It had been accelerating. You're now going quickly, but you're not accelerating more is most likely what we're seeing there. Now we're flipping over and doing the same thing with the buyers overbidding. So the green dotted dashed line is current year, and where we were a year ago is down here. So again, you can see the market's improved. We're going to go back and we're going to start going a year at a time. So you can see we're now at 6 months. Now you're cooling off. There were 12, 11. These are weeks. Now you're starting to improve. And again, right there is last week, and the week before is again a little bit higher. I would actually expect the overbidding to continue up a little bit, and I think the difference between the green being a little bit higher now here in this area is just data fluctuation. I would almost expect the purple line next week to be higher than this week's purple line. Now we're looking at Silicon Valley compared to the 10-year median. So now you're going back and looking at the raw data. The purple number here is where the raw count is. The red line is the 10 percentile, the gray line is the median, and the blue line is the 90 percentile. So this says you have limited inventory. If you were on the red line, you'd have the least amount of inventory you'd expect, but it's pretty close to that, but it's following basically the normal pattern. Here's the actual inventory compared to the median. So now you took the gray line and got rid of the annual cycle, pulled the gray line straight and said, do you have more or less inventory than you typically do? And here you can see you're down here right around that 75% mark of the inventory you'd expect. Doing the same thing now with offers. Here you have limited number of offers, so you're very close to the 10%. And the advantage of doing these lines is you can see the market trend and you can see the huge seasonal cycle that each one of these metrics has and the downfall at the end of the year. The other thing I did, it's unusual, but I think it is useful, is starting in January 2023, I blew out the x-axis, I expanded it. So you have the scale here is much more enlarged, so you can see little fluctuations where you come back here and you can't see them. But this allows you to have a 10-year history, a current pattern for the whole year, and then you can compare the current data to the historical patterns. Here's pulling that gray line in a straight line, and you can see that your active offers is about 79% of where you'd expect it to be. So we're missing about 21% of our marketplace. Here's days of unsold inventory. The purple line again is the current data. You can see you're basically in between a hot marketplace and a medium marketplace. You're clearly away from the cold marketplace. Being towards the red, you have a faster marketplace than you typically do, but not dramatically faster. Here's taking the same line and pulling it out, and you can see you're about 88% of the speed, so you're about 12% faster than you typically are. And you can see the huge slowdown that the pandemic had in February, March, April of 2020. And then you can see the huge improvement afterwards. And then you can see the collapse in the marketplace that we all know about in 2022, and then sort of the recovery ever since. And again, my x-axis expansion occurs in January 1st of 2023. Here's the seller duration. And one of the disadvantages, you can see the market gets down here and it's got these step functions. When you're looking at a small percentage of the total marketplace, you have that. Maybe I should have only looked at the 70 percentile instead of the 75th. But you're down here, you have very fast moving marketplace. It's almost the fastest marketplace we've had for this time of the year. This is the time of the year when the market is the fastest. Sellers are able to sell their property in the least amount of time. Here's doing the same thing where the gray line is now stretched out and you can see what percent. You're about 78% of the speed. So 22% faster than you typically are. Here's the seller's ask price reductions. These are almost exactly cool. In fact, they're a little bit on the cool side of typical. If it was right on the gray line, you'd be completely typical. If you're down here on the blue line, that's the most price reductions you'd expect. But now when you look at it on a percentage basis, this is 99.8%, that's 99.6. So you're about 99.7%. So only 3/10 of the seller, that's the average price reduction for Silicon Valley, 3/10 of 1%, which is, and that's not what sellers aren't taking that small price reduction. It's a small fraction of the sellers are taking significant price reductions, but on average, it's the 3/10. And you can see it's rare that we go up above 100%, but we have been above 100%. That was just before the market correction in 2022. Same concept, stretching out the line, putting it a gray line at 100%, getting rid of the seasonal cycle. You can see that we were pretty close, 99% here, 95, 96, 97, 98, 99. So 99, 99.8%, something like that. So it's basically the right amount, right where you'd expect it, slightly more price reductions than typical. Here's the largest percent, and because the sellers are doing such little price reductions, I'm now ignoring 90% of the marketplace and only looking at the 10% of the sellers that are taking the biggest price reduction. And again, you can see the sellers, the purple line is between the gray line and the blue line. So it's more price reductions than you would expect. And the 10 percentile, their current price is 91% of their ask price. So the sellers that are taking the biggest price reductions, ignoring 90% of the marketplace, is sitting there at about 91%, a 9% reduction. Here's the same information where you pull out the gray line and make it straight. You can see that sellers are taking bigger price reductions. That's basically 30% bigger price reductions than they typically do at this time of the year. This is the frequency of price reductions. That's basically right on the gray line. So you're basically having absolutely typical frequency of price reductions. So if the price reductions on average are greater than normal, that means the sellers that are taking those price reductions are taking bigger price reductions than they typically do. And here you can see just slightly above the frequency, but pretty darn close to it. That's somewhere maybe around 7% more price reductions than typical. Here's the average overbid. So now we're flipping over and this is a lagging indicator, and you can see that the rate of climb up here, and you can see that it starts rolling over in a couple more reporting periods. As you can see, the gray is the typical trend. Right now, we're pretty much on the upswing still, and we're a little bit on the higher side of the gray line. So you're on the high side of the gray line with basically 2% more overbidding. So, and that's 2% of the price. So that can become pretty significant. Here you're looking at the frequency of overbidding. Your frequency is up here somewhere around 70%. So that's 2, 4. It's right about 75%. So 3/4 of the sellers in all of Silicon Valley are getting more than their asking price. And again, San Mateo County was lagging behind, with Alameda County and Santa Clara County getting the bulk of that. Here's the frequency of overbidding, and you can see the frequency of overbidding is a little bit more common than it typically is. And you're somewhere about, what is that, 4% above 4% more frequent overbidding than typical. And now you're looking at sale price. And the big takeaway here is look how dramatic the decrease is, this V every year. Basically, it's a flat line here, but that was 2022 when the market was absolutely on fire. A U where it was pretty much on fire in 2021, but then back to your V. So what's that? Are property values really crashing? I don't think so. I think what's really happening is the type of homes and the location of the homes that are selling are in different areas and lower sale price. And now you can see the correction, and we're now basically almost back up to our highest price ever. You know, the highest price for all three counties was probably about 1750, and we're right now at 1700 even. That'd be 1.7 million. Here's the active inventory for the three counties. So now we're, instead of looking at all of Silicon Valley, we were coming back and looking at county-wide, each individual counties. And the three counties are San Mateo in the orange, Alameda County in the gray, and Santa Clara County in the blue. The big takeaway is look at where Alameda County and Santa Clara County inventory used to be. And you can come out one line because this is the first quarter. So you're down here, you're somewhere right here, you're a little bit lower here. But the only lines that are somewhat competitive are basically 2021. You know, 2023 was pretty similar, but you basically have a less inventory than you would expect to have. San Mateo County is at the bottom because it's the county that has the least amount of population, the least number of single-family homes. Offers accepted, the same pattern. You can see Santa Clara County is up quite a bit higher than Alameda County, where typically they're probably closer together. So Santa Clara County is doing a little bit better than Alameda as far as volume of transactions. The speed of the marketplace, Santa Clara County is the fastest down here at 22 days. San Mateo County and Alameda County are right together at 30 days of unsold inventory. Now we're moving on to the 75th percentile of days on marketplace. So 3/4 of your sellers are selling in 12 days in Santa Clara County, and then San Mateo and Alameda County are right together at about 15 days, so 2 weeks. Here's your magnitude of sale price reductions. San Mateo County is doing the most reductions, and again, it's not very much. It's about 0.75%, followed by Alameda County at about 0.4%, and Santa Clara County is at about 0.1% of the price reductions. And this is the whole valley. So in the whole seller marketplace, not the 90% that I did earlier. Here's the frequency of price reductions. So sellers in Santa Clara County, about 6.5% of the sellers are doing a price reduction. In San Mateo County, I think that's about 7%. And in Alameda County, I'll call it about 9.5% of the sellers are doing a price reduction. Here's your overbidding. And again, this is going to be now a lagging indicator. So San Mateo County is 6% over the ask price. Alameda County and Santa Clara County are right on top of one another. It's somewhere around 9.5% above the seller's ask price. Frequency of overbidding, least in San Mateo County, it's somewhere around, let's call it 65%. Alameda County is right down here at about 76%, and Santa Clara County is at 78% overbidding. And these are the county-wide data. So now I've got rid of the micro market information. Here's the appreciation. Santa Clara County's had the most appreciation at almost 200, which would be 100% appreciation, or double the price of where they were in the last 9 months of 2015. Alameda County is pretty close at about a 90% appreciation, and San Mateo County is lagging behind at 75% appreciation. Here's the median sold price for each county. San Mateo County is the highest at 2 million. Santa Clara County is close behind it, probably about 1.9 million. And Alameda County is the most affordable at about 1.4 million. This is the same information on regular paper. The previous was on logarithmic paper. Here's the estimated payment. It's going to be the same order. So in San Mateo County, the typical median price, assuming an 80% loan, is going to be right around $15,000. Here's the individual numbers, whether you want to be Santa Clara County, San Mateo, or Alameda County, or countywide data. Something went wrong with my processing, so some of these numbers are not on here, and that makes me question the whole numbers. I know the number of new listings is correct at 5% basically across the board increase, from a low of 4% in Santa Clara County to high of San Mateo at 8.7. The rest of the actual numbers on the table only are incorrect. Apparently my link got broken to the data. Now we're leaving Silicon Valley and we're doing the Greater Bay Area. That's in 5 regions. The first one is Silicon Valley, region number 1. Then you have the cities, San Francisco and Marin, North Bay, the 4 counties, Central Valley, 2 counties, and Central Coast being 2 counties. Here is the data. I believe this information is actually correct. It's independent of the previous numbers. Everything looks okay to me. Basically, you can look at whatever metric you find the most useful for what it is that you're trying to figure out. Here's the 5 regions, and you can see that not only is Silicon Valley down in the inventory dramatically, so is North Bay and the Central Valley. So there's basically a huge lack of inventory in the Greater Bay Area. Then you're looking at the number of offers. Same concept. There's a shortage of offers. Santa Clara County is probably getting somewhat more close to normal, but it's still low. And the vertical lines that are faint here are quarters. So you can come back and pick each quarter that you want. So you're actually better than we were in 2020. But that was the worst year because that was when we were in the pandemic. If you come back to 2018, you're a higher number. So we're still having a shortage of offers. You can see how each one of the counties is wrapped up. You can really see the impact of the end of the year holidays. Here's days of unsold inventory. Silicon Valley is the fastest of the 5 regions. Central Coast is the slowest. The other 3 are very close together, about 40 days. So that would take them 40 days to sell the existing inventory. So you can really see that Silicon Valley is much faster, almost twice as fast as most of the areas. Marketing time, this is the 75th percentile, so this is probably the easiest one to understand. In Silicon Valley, you're looking at 14 days. You got a couple areas right here, somewhere around 28 days, so twice as long to sell if you're in the cities or the Central Valley. And then if you're in the North Bay or the Central Coast, you're basically 3 times as long as it takes to sell in Silicon Valley. Here's your Greater Bay Area price reductions, or the most reductions are in Central Coast. North Bay and the cities are next. Central Valley is in 4th place, and Silicon Valley has the least amount of seller price reductions. This is the frequency, probably the same order. The least amount of price reductions, Silicon Valley, then the city, so it's not in the same order. And then the other 3 are very close together and really no difference. Here's the buyer overbid. The cities has almost as much overbidding as Silicon Valley. And that's interesting because they have longer time. So you would expect buyers to come in a little earlier and negotiate a better deal, but they're basically overbidding the same amount. Then you have the North Bay, then the Central Valley. I believe the reason the Central Valley is so low is people are going there for affordability. And so they may overbid, but they're more restrained on the magnitude of their overbidding. And in last place is Central Coast. This is the frequency of overbidding. Here's Silicon Valley shines with the most overbidding, basically 75% for all 3 counties. Next is the cities at 62%, so a pretty significant difference. Then North Bay at about 55%, Central Valley at about 50%, and Central Coast at about 36% of the sellers getting more than their asking price. Here's the total appreciation. The cities is doing the worst. I believe it's San Francisco that's really impacting those. You can see that Silicon Valley has the most appreciation, followed closely by the Central Valley. Affordability issue for both of those, I believe. And then you have the North Bay and the Central Coast in between. Here's the sold price. You can see that the cities is the most expensive, followed very closely by the Silicon Valley, Central Coast, North Bay, and Central Valley as being the most affordable. This is the payments. They're in the same order because they go through the same formula to calculate what the payments are. It's assuming a 30-year fixed mortgage on an 80% loan. We've been talking about week number 14, which is April the 6th here in Silicon Valley. The blue is the direct YouTube archive. I also have a shorter typing one if you want. The green, I call that my root URL. If you want to participate live Saturday morning, you type in the green root URL plus 2024 to get there Saturday morning at 9 o'clock. If you want the handout, you type in the green URL, H for handout, and then the year, month, date code. So this is presented on the 6th of data, 6th of April, so that's why 0406. The data's through early morning of the 5th, but I present a day later on the 6th, and that's because I use a real estate fiscal year that starts on March 1st every year. This has been a presentation of Silicon Valley real estate market geographically of single family homes. It's the most current. Basically, the data's through Thursday morning and it's presented on Saturday. That's pretty fast turnaround. It's the most comprehensive. There's so many different metrics. I don't know if anybody that offers more. In fact, if anybody knows of another metric I should be following, I'd be happy to look into it. And I also correct the data. There's a lot of data entry errors and a lot of duplicate listings on more than one MLS, and I delete those. I search and do a pretty good job of getting them all. I may miss one or two, but I am deleting almost that I can find. I use a 5-week period because I believe real estate has a huge weekly cycle caused by weekend showings versus most people look at report calendar month dates. Calendar months are also important because you have months like February that have 28 days, and then you have other months that have 31, but they also have different number of weekends and weekdays, which has a huge impact, and that varies from year to year. By using a 5-week median, I'm comparing the same week all the time, and my year, because of leap year, starts on March 1st, and then I look backwards. So I go from March 1st, I jump forward 7 days at a time. When I get around to February 21st, I jump forward 8 days back to March 1st. Except in leap years, I jump forward 9 days, and that gets rid of the fact that we don't have an even number of weeks. I look at offers accepted versus pending. The problem with looking at pending transactions, which most of the other people that analyze the marketplace do, is if you're in escrow for a longer period of time because you're having buyers having a hard time getting the loan, that particular transaction impacts the statistics for a longer period of time than the offer that comes in with cash and closes in 1 or 2 weeks. I look at 20 micro market areas, and that's what I start the presentation off with. I then look at the combined Silicon Valley. I then come back and look at the 3 counties individually, and those 3 counties are Santa Clara County, San Mateo, and Alameda Counties. I then move on to the Greater Bay Area, made up of 5 regions, which include 13 counties here in Northern California. I look at the supply, the demand, and the balance compared to their 10-year medians. So you have an idea of whether you have more or less inventory for that period of time. I then look at the current supply-demand ratio. That's the speed of the marketplace you're going to see right now. On days on market, time to sell, I look at not the median and average as most people do. The average has a drawback of when one seller that was on the market for a long time sells, after a year or two, he really brings up that average. And the median has a problem because it's so low, there's a lot of step functions. So I have taken on the 3/4, the 75th percentile, and reported what that person's doing. It gives you a very sensitive measure that moves up and down almost all the time smoothly. However, when you do get a very fast marketplace, you do get the step function that I try to get away from. I look at the seller's expectations versus market conditions, and I measure that by looking at the frequency and magnitude of price reductions. I then look at the buyer competition, and I look at that again by the overbidding frequency, magnitude, and frequency of overbidding. I then look at the appreciation since 2015. I elected to go with a 9-month period of time because I wanted a stable market. And one of the things you quickly learn about Silicon Valley is the first 3 months of the year is when you see some pretty radical price changes. And therefore, I eliminated that by looking at just the last 9 months. I picked 2015 because it was back in time and it was fairly stable in pricing. I look at the low, typical, and high price instead of just the median. So you have a sandwich effect. You know what the total price range is. And then I bring in the total monthly payment, including PITI, principal, taxes, and insurance. And I'm assuming an 80% loan and a 30-year fixed rate loan using the national average. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers and sellers here in Silicon Valley since 1981. Happy to reach out and talk to anybody that wants to discuss real estate. Thanks. Have a great week. Bye for now.